this special broadcast live on Moneycontrol. I'm Stacey Pereira, and today we're going to be discussing something very interesting. In fact, in the only last week that we heard of Info Edge initiating a forensic audit into Rahul Yadav-backed PropTech startup, that is 4B Networks. Now, Info Edge had made investments worth about close to 150 odd crores and had made these in this capital infusion into 4B Networks, which was then valued at somewhere around 1,500 crores. But things seem to have gone south, and now we know that Info Edge has appointed Deloitte to go ahead and do a forensic audit in order to read these discrepancies. But the whole episode has once again called for a stronger due diligence practice, as well as for investors to make sure there is a post-investment monitoring system in place. Now, while Rahul Yadav has become this infamous bad boy of startups, this is not the first incident that is coming to light, and it follows at least 3 major instances of corporate governance lapses in Indian startups, including Bharat Pay, Zilingo, Trell, Go Mechanics recently since 2022. And this all brings us back to that moot question, that governance lapses, whether it is, with the funding taps drying out, with VCs being more cautious now, how are startup founders as well as these VCs supposed to navigate the startup terrain? Now, joining me to discuss this is Siddharth Pai, the managing partner at 314 Capital, K. Ganesh, serial entrepreneur as well as promoter at Big Basket Portia Medical, as well as Tarun Joshi, the CEO and founder of Joint Ventures. Thank you, gentlemen, for joining me in this special broadcast. Well, we have time and again gone back to this issue, and we are continuously seeing that there is no permanent solution that we've reached to as yet. K. Ganesh, I'll come to you first. Are we really seeing a correction when it comes to valuation, or is this just a function of the excess which is now stabilizing? How are you reading into this whole situation?
No, so I think there are 2 different issues here. So one, clearly valuations compared to the high and euphoria that we had have corrected. That's pretty par for the course. It's part of the cycle, just like public markets goes through highs and lows, the cycles happen. Currently, we are in the low cycle, contributed by multiple factors. There was a lot of money chasing a few deals. The ticket sizes were larger, the valuations were higher, the deals were getting closed faster and faster, short level of due diligence, and there was a hurry to beat out your competitor, other VC, to get into the deal. We saw all of that stuff. Now, as a part of the reverse of the cycle, as it often happens, we are seeing the reverse. There is funding winter or freeze, whatever you may call it. The valuations are down, the ticket sizes are down. What would have taken a couple of months are taking 6 to 9 months. And the quantum of funds, easy money has also dried up. Interest rates have gone up. So all of it is par for the course. The second separate issue that we started with, you're talking about, is the corporate governance issues that have come up, either of misreporting or of fraud or of use of funds contrary to what has been agreed, and also the role of the investor, how much hands-on to be. I think that's a different question. That's an interesting question. In fact, I'm not surprised, because the number of such cases that come up still is a minuscule of the fraction. Even assuming there are unreported cases, this is not generic of the ecosystem. But it has shown the mirror. It has shown the fact that we need to observe a lot more, put in a lot more effort, observe caution, and monitor more closely. One of my pet peeves is, as the companies, startups, they raise more and more money, they employ more and more people, they see higher traction and revenues, then they can no longer hide under the name of a startup or nomenclature of a startup and let corporate governance go. The same like you expect listed companies to follow governance procedure, have an independent director on the board and follow procedures. The same thing should apply. I'm not saying at Series A, I'm not saying at startup level. The moment you talk about 100, 200 employees, 500 customers, 100 crores of revenue, then you can't say, I will not go, I'm a startup, oh my God, so I can't do bureaucratic governance principle. So that is where I think we need to relook and at the startup ecosystem and say the mode of governing, treating, having structures for a startup beyond the seed stage with some de minimis on number of employees, number of customers, number of amount of money. We need to follow the guideline.
Right. So there are there are two parts to this story. Let me get in Tarun here. But, investors cannot simply just blame that big deal inflows and everyone wanting a piece of the pie and then not being thorough with those responsibilities towards due diligence, one would say. But the challenge is also on the startup side, where they are trying, or rather, the sustainability of that frantic pace of growth. So how does one really keep that balance?
Yeah, Tracy, I think I can relate to both sides of the story because my background is I used to be a private equity professional for 10 years before becoming an entrepreneur. So I do understand the challenges on both sides. I think there is just no leeway towards not adhering to strong corporate governance standards. I think that is very well documented during the time of investment documentation. I think it's a question of each startup entrepreneur being aware of the responsibilities that they owe to the investors. There is a lot of trust factor at early stages, but as the company matures, systems and processes are definitely a responsibility of the company and the founding team to set in place. I would also say that the more we democratize the processes rather than single person driven, they tend to become stronger in a company and make it larger and stronger. I think these were areas which, as Ganesh mentioned, during early stages of a company, you are so focused on growth, beating competition, trying to figure out product market fit, that there is some leeway that everybody understands and is willing to give. But I think as the scale of the company starts to touch probably about 150 odd crores plus in revenues, it's something where not only founders but specialists should be involved. Stronger auditors, stronger internal audit systems also need to be put in place, because these are things which specialists do tend to educate companies and founders much strongly and is much more needed than ever.
Right. So, Sidpai, do you think that, now investors are getting unnecessarily more cautious? Is that what is happening, and is that going to really pinch founders? Because if they do not have that right guidance at an early stage, they are probably not going to be able to get in more of those investors or make those pitches. So how is this going to be looked into?
So I wouldn't call it being unnecessarily cautious. I think most of these investors have a better appreciation of the risks that are actually involved with making investments. I think I always keep saying in the early stage, the greatest risk you end up taking isn't business model risk, credit risk, etc. It's actually the people risk. And there's very little that any due diligence firm across the entire world can actually do to sort of discern intent from ability. I think figuring out that intent and actually getting a gut feel as to whether this person can actually be trusted with the funds, what are the oversight and guardrails you need to end up keeping, actually becomes a very important piece. Now, what happens is every time there is any sort of issue like this that happens in the ecosystem, it actually does paint the entire ecosystem in a very bad light. Investors turn a lot more cautious, and indeed investors don't need another reason to end up turning cautious now, especially in light of the funding winter that's actually there. For that matter, numerous investors and VCs, rather than making new investments, are choosing to actually introspect and go through their existing portfolio to try to identify any new red flags that are actually coming about. So I think transparency is actually the name of the game right now. The more transparent that a founder actually is, the more they end up running their ship in a proper way, and the more they don't end up getting, I would say, beguiled by these low-hanging fruit and sort of using the company to end up subsidizing their lifestyle or actually diverting company funds into sort of personal projects and the like. So I think these sort of guardrails of governance, which actually essentially, if these come out a lot more strongly, there is a much greater premium to be paid. I think all of us can recall that even in the listed market as well, there are some companies that end up actually governing an exceptionally high premium purely on account of the governance as compared to any of the other firms. And they're going to see similar kind of practices start actually coming on to the venture capital and private equity space as well, where well-governed firms that don't have any issues in their diligence, where they have good investor relations and they have a good name in the market, can actually attract capital even during the toughest times. So I think we're actually seeing this kind of shift and good behavior come in, and market forces will ensure that those who end up looking to deceive investors, for that matter, will not be able to succeed or actually raise another venture in case the current one is actually jeopardized.
Right. So it is about picking those apples and not letting everyone call out startups as a whole as being the bad apple. But let's look at the other side, which is funding in startups. And well, over time we've seen the funding really plunge, especially if you look at just this year. In the 5 months, we've seen it come down to just $3.3 billion compared to the $15.7 billion that it was in the same period last year. So we are talking about this winter, but do instances like this make sure that this winter gets prolonged, because now everyone's going to be are upping the ante, they are going to be asking more questions when it comes to the VCs and Ps. But what about startups as well? Does this mean that we are going to be staring at a longer prolonged winter? K. Ganesh can take this question.
Yeah, no, so I think this cycle, I don't think we should read too much. Obviously, multiple factors came in together at the same time. We did see a euphoria during COVID and slightly during pre-COVID. That euphoria was unsustainable, and now we are seeing the correction. I don't think these few instances, see, even if we really look at it objectively, we are talking about tens of thousands of startups, and the number of cases we are talking about, you can count in fingers. Obviously, there's never a single cockroach. I'm sure there are more similar instances which will not come to light, but still it is a fraction. So in my opinion, I don't think it is going to prolong it in any more than what it would have been had these incidences not come up. But having said that, obviously each of these incidents is in top of the mind, right? You can't shake it away. So therefore, while either during the pitch or during the courtship process from the entrepreneur side as well as from the investor side, governance will get discussed. The rights of investors to inspect books, rights of investors to veto, the right of investor to be able to get information and a level of transparency, all of this will be part of the discussion more than what would have been normal, because all of us tend to relate to recency bias is always there. We tend to relate to what has happened just now. But I don't think it's going to extend anymore. Obviously, it's one more additional point in the discussion. I don't think it's anyway going to affect the decision making in any way. There are various other factors that has led to the funding winter and the slowness that is happening. Those things need to be addressed, and hopefully we'll come out of it. I don't think this will per se affect the timeframes.
Right. So let me bring in Tarun now. So being an investor as well as what is the checks and balance you're going to have to keep? We talk about better practices. We are talking about bringing in more transparency. But is there like a checklist? And I'll come to the others as well on what they have on their checklist before they when they hear a pitch and then want to really put in money. What is the checklist that you're looking at as a VC?
So I think the checklist stays the same. I think it's increased amount of importance being given to each element of that. And also, I think one important area which has come out is the faster you do it, the better it is, which means post an investment, the first 6 months are extremely crucial. The way about 3 to 6 months spent before doing a deal is very much into understanding the business, trying to do all the due diligence which is required to sort of enable that investment. Immediately after the investment is made, I think formulation of a very strong board. And when I say a strong board, it's a board which can actually operate quite independently. It's a board where founders should also take responsibility of sort of reporting to in as transparent a manner as possible. I think putting up sort of stronger processes in each of the areas, like there is a heightened now requirement of what we call as a larger piece called ESG, which is environment, social, and governance. All practices which usually companies at small scale do tend to miss out. I think there's a role that external consultants and specialists are playing around that. Also, I think creation of subcommittees at the board level, which can actually interact at a deeper level with not only the founders but sort of the professionals which are running, because they are also equally well incentivized. And a little bit of education, if provided better at the next level or of management, I think ensures that the company gets out stronger.
Right. Okay, so Sid, you come in here and tell me. Now, this is one side. We've spoken about the winter. We've spoken about how corporate governance could be a deterrent if people are not keeping that, something that they have to make sure that it's priority basis when they are, in a startup ecosystem. But what's happening to the valuations? We spoke about this at the start, and we are looking at this trend of valuation markdowns now, and across unicorns, decacorns, to name a few, Swiggy, Pharmacy, all of them have seen those valuations really being slashed. So is this really telling a story then even to the people who are looking to be investing? Should we be judging these companies on the potential of what they're going to deliver, or just those lofty valuations?
So I think it's very important to contextualize the current slashes in valuation that we've seen. A number of these slashes have actually been driven by accounting standards as well as the risk management policies of these particular firms. Now, usually what happens is accounting standards, especially IFRS, including Ind AS, etc., and US GAAP, actually insist that on a quarterly basis that the manager ends up actually assessing the fair market value of the investments. And in case a manager believes, as per a previously disclosed risk assessment framework, if the company's valuation doesn't actually match to what is recorded on the books, that the valuation should actually end up getting slashed. Now, a large amount of these are subjective, which is why you can actually see for the same company, no two investors have actually agreed on what that particular slash looks like. It goes all the way from 20% to as large as 60% as well in certain cases itself. I think the true determiner of whether a company has actually seen a valuation get slashed is when the company actually raises capital at a much lower valuation itself. Otherwise, this is primarily the opinion of one particular investor as to how they want to end up valuing that particular stock as per the risk assessment frameworks that they end up having. I think when we start seeing down rounds to end up going through, we are actually going to see the maturity of the startup ecosystem come to the forefront. If you look at the listed companies as well, their valuations actually change on a day-by-day basis. And unless there's a massive drop that is actually specific to that particular company, usually the company's management doesn't actually end up commenting on that. I don't think valuations are permanent. Valuations actually end up changing as a function of the fundamentals of the business, the actual potential they have, macro situations that end up existing, as well as investor sentiment. We're seeing fairly low to negative investor sentiment almost across the entire board. We are seeing the macro situation being very precarious, especially in the Western world, in the US, the UK, as well as other areas also. We are actually seeing in terms of fundamentals, a number of these businesses are looking to turn profitable. They may not be doing it as aggressively or as quickly as what certain managers or certain investors end up actually liking. So I think if we do start seeing down rounds, we should actually see maturity to accept money for the sake of business continuity. I think Flipkart also suffered through a couple of down rounds and then had the largest exit on the Indian startup ecosystem itself. So it is a journey, and valuations are essentially vanity metrics right about now. Value creation is what all investors are looking for, and even manage all the operators and founders to end up actually concentrating on this. And if they do, the valuation will automatically follow through on that.
Hey Ganesh, your take on this whole valuation downturn that we are seeing, is this really weeding out the bad apples, making people more aware and also bringing maturity to the ecosystem? Would you agree?
No, I actually agree with Sid. Just to add to the point that he mentioned, see, this slashing the valuation is accounting exercise by an existing investor in the book. There is no money lost. Nobody is crying. No transaction has taken place. Nobody has sold at that slashed valuation at which he is marking down the books. And it is being done more on a conservative basis because that's what they expect to do. But no shares have changed hands at that price. Therefore, beyond that, recording that particular incident has happened, nobody is crying here. So I don't think we should bother about it at all. If you look at it in the public markets, great stocks, take Netflix, take Amazon, stocks have slashed much more than this. Here we see sensationalization by the media that, oh my God, somebody has marked down by 10%. I forget the company. Latest markdown was 10%. Yeah, of course. But look at listed stock and great stocks, Netflix of the world, which are, prime market category leaders, down by 60%, 70%, 80%. Compared to that, this is nothing. So I think too much attachment is being given. Nobody is crying. No shares is changed. It has no relevance to anybody. Yes, when the next round happens, if it happens to be at a lower round, then there will be anti-dilution clauses will apply. The earlier investors who came in at a higher price will get compensated as per the anti-dilution formula. It's weighted average or full ratchet mechanism. Everything is happy, it's fine. What does it really mean for the entrepreneur or the founder of the company? The markets were high, so you went out and raised money at high valuation. Now the markets are low, you need to raise money, you are raising money at lower valuation. So who is crying? Whether it was good you raised money, good for you. Now it is low, you still are raising some money, and weighted average will apply, everybody gets compensated. It's not happy. I have been through down rounds and again up rounds later. Yeah, sentimentally, emotionally, you feel bad that you want to see up, 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 up. It is like the market value of the apartment or home that you're staying in come down, or the jewelry that you have your locker which your grandmother has given you has fallen in value because gold price has come down. But the transaction is not taking place now. So whether the property or the gold, your ancestral jewelry, I mean, why would you bother about it? I think we should just companies, founders should focus on execution, raise money if you need to. Only word of caution I would say is I also hear because of optics, people are trying to hold on to the same last round valuation so that they don't have to report to media. They don't get vilified in the media that there was a down round. So they try to hold on to the same valuation by doing structured deals. Now that can become very dangerous. What I mean is, I'll give you the last round valuation, treat it as a flat round, don't show it as a low round, but I guarantee you a certain IRR and all that. Those things can come very badly to bite you. So my own suggestion, recommendation is bite the bullet. Take, even if you have to raise money and get a lower valuation, take it, apply weighted average anti-dilution formula. Don't go for complex structures just for ego's sake so that you are able to report a last round valuation. In reality, it's a structured deal. It will come to hurt you later. So, but otherwise, I'm not very concerned about this. But I do hope the funding situation eases, deals come out faster, and more and more deals happen.
Right. Tarun, there's always this debate or dilemma rather between, growth and profitability, and most of the startups that we know of, at least the ones that are out in the domain that people are aware of, have been fighting this. And when it comes down to people, then suggesting, oh, well, they should get their unit economics right, they should get all the financials in place. Where is that, now adding this corporate governance factor to that as well? Is it really an important focus area, and how is a startup supposed to be, managing all of these parameters together?
So I think fundamentals of the business have always been extremely important. I think it's the wave which sort of pushes you in one direction or the other, and then you try and find a balance. I think there was an increased amount of focus on, if the target market is extremely large for startups in India or businesses in India, why are you not growing faster? And therefore, there was an increased amount of importance given towards growth. Now, certain companies took that balance, growth versus certain companies which actually went out and actually were fighting for a larger growth, right? Which I think there is no right answer in that. It's a company strategy. It's driven by external factors like market share, who is the first mover advantage, and things that can help you. But most important thing is, all private investments are supposed to be long duration investments. Now, when you look at it over a 5 or a 6, 7 year cycle for a startup, where whatever stage it is in, you will have to keep doing these balancing acts. At times you will have to go for growth, and at times you will have to just put the accelerator low and sort of start looking at how can you actually make money. I think we are in a tide where there is an increased amount of importance towards how can you make money. And I think that's very good for the ecosystem, because that ecosystem has actually got everybody to start thinking that eventually what matters, and some of the fellow panelists explained earlier, is value creation. And value will get created at a point when the company is actually making profits. And if that journey has to start little earlier, there is no harm in it, because you can always course correct during the time. Now, answering your question around corporate governance, yes, that was also always within this long journey was supposed to hit. Now, in some of the cases, that would start maybe just 2 years before an IPO. Now the market has started giving more importance towards that because of 1 or 2 or 3 cases which have sort of come out in the limelight. And there is a course correction that why wait for so long and start it early. But I think all these are basic fundamentals of running a strong business, and those should be adhered by companies, investors, and everyone in the ecosystem.
Right. Let me get a last word from all three of you all on, what would be your message? I think K. Ganesh already gave a couple of suggestions for founders. If they had to be, they should just, go out there even in a down run. But let's get Sid Pai. What would be your suggestion as a VC yourself? How are you, how do you go out there, or how do you get approached, and what are founders really supposed to keep in mind, as well as the VCs when they are, writing those fat checks?
No, I think the most important thing from a founder's perspective is to ensure that they run a clean shop and that they have business continuity in place. Like I said, a valuation is actually a vanity metric as of now. You always have to end up growing into your valuation over time. And there are certain factors about a valuation that are out of your control. So don't keep valuation as the end all of your business. There are great businesses who are extremely undervalued. There are not so great businesses who are very overvalued. Ultimately, the market corrects it. It will take time for the market to end up gaining confidence on what you do. The second thing is, I don't think you should end up taking governance as a sort of like it's a tick in the box kind of thing. Good governance is a lot like personal hygiene. When you do it well, no one actually notices. But when you do it badly, nothing can actually end up hiding the stink. So I think people should actually internalize this and make sure they end up running a clean shop, because that is eventually what ends up compounding over time. I think from a VC's perspective also, we have 94,000 startups in the country and the numbers are always increasing. Just because you end up actually missing a deal because you have to end up cutting corners, that will eventually end up coming back and actually affecting you. So be more circumspect in what you do. Make sure that you have a strong practice within to maintain oversight of your portfolio. And if you do that, these returns will actually end up compounding over time. And you can avoid making some of the mistakes that have unfortunately plagued the entire industry as a whole.
Our last suggestion, what would you be, asking VCs to be looking out for, as well as the startup founders? What should they be really focusing at this point?
Yeah, I think transparency, very important. Investors and founders both have a common goal, which is creating a lot of value for themselves, for the ecosystem, for everyone. I think have a very process-driven approach, democratize decision-making such that you are creating a business for future. Don't cut corners on any of the stages, whether it is around being genuine while you are raising capital, to whether you are planning for an exit, or even during the mid phase, which is growth. Because see, for value creation to happen, you have to actually do all three things right? From an investor's perspective, you have to buy right, you have to build it right, and then you have to exit right. So it's a journey which requires a lot of collaborative approach and a lot of openness, transparency towards building sustainable companies.
Well, that's right. We got quite a rounded perspective. We could say a lot of suggestions as well as advice to VCs and startups for now. But it seems like we could conclude when it comes to the valuation, that situation seems bleak as of now, and only time will reveal how many companies really come out strong. Well, for now, the startups will really have to be focusing on those unit economics, on being transparent as much as possible, the path to profitability, as well as tide through this winter for now. Gentlemen, Siddharth Pai, K. Ganesh, as well as Tarun Joshi, thank you so much for joining us in this special broadcast. And to all our viewers, thank you so much for tuning in.